Markets are all over the map today as Chair Powell spoke and the Federal Reserve gave their decision for the 75 basis point rate hike, just like they had suggested, telegraphed, and the market was expecting. And one of the things that's interesting is the memes that are out there, like if everyone's expecting it, it probably won't happen, or it probably will happen, or whatever. And this was all forecast in. The market knew 75 basis points was coming. So why then was the market up ahead of the Fed decision, down substantially after the decision was announced, and then up during the press conference, and now it's back down again, all in about an hour. 1% moves either way, from being up 1% to down 1%. Now we're about 0.5% down overall. And what the expectation would be is for the market to continue to sell off into the close over the next 30 minutes and then down the next few days, pricing in what the Fed said and what they are doing. And a couple of the reasons the market was up during Powell's talk was that he mentioned envisioning a point where the Fed could slow the pace of rate hikes. He didn't say stop. He didn't say pivot. He said slow. Anytime Powell says slow, the market reacts and jumps. But what he said was the same thing he said at Jackson Hole. He said, I'm reiterating, our Jackson Hole stance has not changed. The other thing that he said, and I don't know how many times, but I bet you over 100 times, he said restrictive economic conditions, restrictive policy. And at that last meeting before Jackson Hole, the last FOMC meeting, Powell used the word neutral policy. The Fed had reached neutral, which nobody knew where that came from, why that came from, or even how he could justify or even calculate that. He was very clear this time to say, we want restrictive conditions, we want restrictive policy, and we are nowhere near that. So now the market is repricing in what initially they were looking at was 3.5% Fed funds rate by the end of the year. Now it's up to about 4%, 4.5% by the end of next year, and continuing on from there. And the Fed does not envision inflation coming down for a couple of years now versus the transitory conversation. And he even said today that we thought we'd see loosening in the supply chain. We have not seen that yet. We're still seeing constraints in supply chain. Labor market's still strong. He said the economy is still strong. So from the Fed's perspective, they believe they have plenty of room to run and continue to hike rates. We will probably, as of today, there is a likelihood of 75 to 100 basis points again at the next meeting, and then potentially coming down after that. But right now, the target is what it is. They put it out there, 4.5% by the end of 2023 and 4% by the end of this year. So today brings us up to that 3.25, I guess, somewhere around there in terms of the rate hikes. And, very restrictive policy, very restrictive financial conditions is what the Fed is after. That's the big news out of the Fed in the markets today. And then, of course, the other big news is Russia and Vladimir Putin mobilizing and enlisting, 300,000 people are trying to in Russia. There's protests now in Russia. There's protests in Iran. So the world is changing. People are lashing out and fighting back against these types of things. And then, of course, the nuclear weapons threat that Russia has been saber rattling and things like that. So there's potential escalation there as Putin gets more and more desperate, as he loses his grip, and this war is not working out the way he thought it would, or his special operation that he likes to call it, and more of their crimes and things are exposed. So there is still a big risk and potential there for that to escalate. So hopefully we can end that and end him before any of that happens. But those are the big items today. Putin and the Fed are weighing on markets. And as you can see right now, markets are continuing to decline a little bit. Let's take a look at Bitcoin. Bitcoin initially, this is on the daily. Let's take a look at the hourly action. You can see where, the Fed made their announcement, then it's up and down. So Bitcoin's been kind of all over the map here today with everything that's going on. Just like if we go over here and look at the dollar was up quite a bit. Now it's back down. So the dollar's working. So we've got spikes in a lot of different directions. If we look at the industrials here, up, down, all those types of things, NASDAQ doing the same thing, S&P doing the same thing, all of this during, the announcement, rate hike announcement. all of the markets reacted. Treasuries jumped. The 2-year Treasury jumped big time on the news. And of course, the 10-year, let's take a look at bonds, is continuing its journey upwards. Oh, the other big item too was that Powell said that they are not going to start rolling off. Nobody asked him about QT, but he did say that somebody asked about mortgage-backed securities, and he did say they are not considering selling any mortgage-backed securities at this time, and they're going to announce that when the time comes. So right now, those are all of the things coming out of the press conference. So let's take a look at a few things here real quick we haven't looked at in a while. Let's look at the weekly moving average on the Dow Jones, getting closer to that 200-week moving average and our June lows. And I think it looks like over probably the next couple of days, we're going to be testing these support levels, testing that 200-week moving average is what this is. This is the Dow, S&P, and NASDAQ on the weekly, and testing those June lows. Here's Bitcoin still below the 200-week moving average, and testing, getting back to where potential test of the June low, but rejecting on the previous 2017 previous all-time high. So that's what's interesting at Bitcoin. Let's take a look at it on the daily, below all daily moving averages, rejecting right off of that 2017 high. So we'll have to see if price, stays below, gets above, what it can do as it goes along. And then here's the industrials now below all moving averages, NASDAQ below all moving averages, and the S&P below all moving averages. So next stop, June lows and the 200-week moving averages on the major indexes. And as we know, Bitcoin, crypto are all following the markets because it's all risk assets. And we are in a risk-off environment right now. And until the Fed is done, we're going to remain in a risk-off environment. And that's really, the moral of the story is we've never seen a market bottom. So people are calling for bottoms and things like that, or that the bottom is in. The bottom is definitely not in. We traditionally, when you're in bear markets never bottom until the Fed is done hiking. So you go back and look at 2017, 2018, and let's take a look at these charts real quick on 2017 and 2018 for the traditional markets. And even Bitcoin, obviously, back what happened during that time frame in 2017, this was the time frame when the Fed was doing their thing and the tightening cycle, and then they pivoted. So let's go look at the S&P during that time frame. So this was the last tightening cycle right here. That's what was going on here. The Fed started its tightening in October of 2018, and markets were unwinding as the Fed was raising rates. This was the final credit market repo blow up right here where the Fed pivoted. And again, we did not have inflation at the time. We didn't have financial conditions like they are right now. So the Fed could pivot. And this is where they pivoted. And this is what a pivot looks like. But even then, that was December to May. So it still took 4 or 5 months for price to get back to where it was ultimately in a Fed pivot V bottom. So this is a buy the dip Fed pivot V bottom right here in terms of, a market recovery. We had a little bit of a correction here in May, and this was a 20% drop, by the way, at that point. It was about 20% down. This is the March 2020 pandemic. I believe that was 30-something%. Let's take a look at what the S&P did there. I think it dropped about, 35% there. Fed, liquidity, zero interest rates, jumping in, juicing the market, V bottom recovery, and basically took from the bottom of March 2020 to around August to get back to the levels before it crashed. So here we are now. And what we have right now, again, is the Fed continuing to tighten, and they haven't really started QT. They haven't even started unloading, and they're not going to unload mortgage-backed securities. Market still has a lot of work to do. The Fed said, we want restrictive economic conditions. We want restrictive financial conditions. So with financial conditions that the Fed targets through their fund rates, you have restrictive, you have neutral, and you have accommodative. This was accommodative. This was accommodative. And then let's go back to the granddaddy of them all, 2009. That was accommodative. That is Fed-induced V-bottom recovery, quantitative easing, zero interest rate. That's what that looks like. Where we're at right now is restrictive policy. We're not done yet. We're going to do everything it takes to get down to 2%. We do not see that happening for a couple of years. So inflation. So the market has a lot of work to do. The market has not priced in where the Fed funds needs or is going to get to by the end of the year. So that's going to happen over the next couple of days, weeks, months, as markets will continue to come down and test these lows. But again, markets have never bottomed while the Fed has been tightening and doing, raising interest rates and doing QT. Markets have not bottomed. Markets cannot bottom with inflation running at all-time highs until inflation is under control, plateaus, starts working its way backwards. When the Fed stops tightening, not slows the pace, but stops tightening, then that's when markets can find a good bottom and start potentially putting a bottom in. And then when the Fed starts juicing the market again, either reducing interest rates or another form of QT or something like that, then that's when you can look for the next bull market. But this is very different than other times. A lot of analysts, a lot of investors, a lot of people that are in the industry now in traditional markets as well as crypto have never been through anything like this. They've never seen a bear market. They've never seen a Fed tightening cycle. And to everybody's credit, we've had a Fed put in place for quite a while now with Powell, where anytime something breaks, stresses, or cracks, he just pivots and juices the markets again. The difference is this time, from an economic standpoint, they can't because of inflation and the damage that will do. We talk about that, where that will create a jobs problem. But right now, the jobs, he said, we have a long way to go before jobs are a problem. And he's targeting, he wants some significant increase in unemployment rates in order for them to be able to get back to neutral. So they're going to be restrictive. They're going to continue to raise rates and do QT until we see the labor market correct and we see inflation come down. So those are the two benchmarks where you can start putting a bottom in, and maybe these levels hold. I don't know that they're going to break. We're going to test them. And if they do break, then we'll start getting down and we can start carving out and putting that bottom path in. But this is going to be a slower process to expect a V-shaped recovery in the markets right now, like we saw back in June when the Fed said we're at neutral. That was the telegraph to the market. I don't know why he said that, because it wasn't the case that the Fed was done. That shows you the power of what can happen once the Fed is done. But we are far from that. Long way to go yet. The lows will be tested. And again, markets have never bottomed while the Fed's been tightening, hiking, and inflation has been above the Fed's target. They have a single-minded focus right now. Inflation. That's it. They don't care about the labor market. They don't care about recession. They don't care about the financial markets. They're going to let something break and then evaluate if and what they do at that point, or if they just let it go and let everything correct, because we're at the point now where financial markets need a reset. And, at some point you got to just let the chips fall where they may. And we might be at that point in the economy and in our global financial situation where the chips have to fall where they may. The markets, some of them still don't believe the Fed has it within them, but they've shown unanimous support from Jackson Hole now. And you're going to see anybody who talks after this meeting, unanimous support. We're getting inflation down. That's our mandate, because it's doing real damage and it's hurting people. But also you've got an election cycle coming up, and they want to make sure they know that that's going to hurt their, incumbent administration. But more importantly, the presidential election in 2024, and you can see how their forecasts are all talking about everything's going to be resolved by then. So that's going to be the messaging from here on out. Come 2024, everything's going to be fine. So that's what they're targeting. They're going to be as restrictive as possible till then. Midterms don't matter. It's the presidential election cycle. So we've got a lot of pain ahead. He said that, didn't say it much, but there's still pain ahead. Restrictive was used a lot, and inflation down to that 2% target, no matter what it takes, as long as it takes. So higher for longer is the narrative. That's why markets are doing what they're doing. So we just have to watch them into the close, see what the next couple of days look like, and expect a retest of those June lows to see if they hold, and they might. And if they do, we can carve out more of a longer term bottom maybe in that area, but there's still a lot of repricing that has to be done ahead of that. And then of course, earnings start to come out, and then recession and things like that. So these are the things I'm looking at. Big day today. I'll see you in the next video.